welcome to Kaplan Professional Education Australia's 5 Minutes with the Industry program. Today I'm here with RBS's Elizabeth Tian, who'll be discussing the benefits of gearing strategies. Liz, thanks for joining me.
Thank you.
First off, what's the advisor's role when it comes to gearing strategies?
Advisors' role in gearing, like across all investor products, is basically to make sure that the client situation is suitable for that type of strategy. Client suitable, they've got the right time frame, they've got the right risk appetite, the underlying assets are suitable to the client. So they've got to know the client very well, and also they've got to know their products very well and make sure they really understand these products, translate the risks as well as the benefits to the clients to make sure that there's a match between these two.
Given how volatile markets have been, are gearing strategies still appropriate for clients?
Absolutely, in certain circumstances. I think gearing will always be there and always is a strategy that will be used, despite what we've seen in the markets in recent times, people deleveraging, margin lending, using a line of credit from your home to gear. These are all just different forms of gearing, and people have to understand not only the benefits of gearing when the market goes up, but the risks of gearing if the market were to come off. Understanding things like what is the appropriate buffer for the client if they're gearing, what's the appropriate gearing level. If you've got $2 million worth of assets, if you've got a home that's paid off, if you're earning good income, a level of gearing is definitely suitable to some clients. It depends on their time frame, also in their investment. Generally, with gearing, most advisors recommend between 5 to 7 year time frame outlook.
Can you talk about some of the gearing strategies advisors and their clients can use?
A typical gearing strategy is to use either a line of credit, and that's basically if you've got equity in your house, to pull some of that equity out and use that equity to buy growth investments. That's one strategy. Another strategy is to use margin lending. Now, people may use margin lending because a lot of mums and dads out there like to keep separate their investments and gearing in their investments from their own residential home. So they may use margin lending, and they can use things like dollar cost averaging, starting with a sum and every month just borrowing, say, a portion, $1,000, you match it with your own $1,000 portion and just drip feeding into the market as one strategy in margin lending. You've also got a cash extraction strategy. Some people have quite a lot of assets. They've got assets that they don't want to sell. For example, people who've bought Commonwealth Bank shares in the float. Obviously, CommBank shares have done extremely well. People don't want to sell their shares, and what they do is do a cash extraction. The concept is similar to, say, going to a bank with an unencumbered property, giving the bank that unencumbered property, putting a loan against it, drawing out a loan to buy a second investment property. Now, that's a very popular strategy, and you can do the same thing also with shares. Another type of strategy used in gearing is to gear within your self-managed super fund using installment warrant gearing.
Can you give some more details on the benefits of using installment warrants?
A popular strategy used with gearing is gearing in self-managed super fund, and one of the only ways you can gear in a self-managed super fund or in super is to use an installment warrant loan, because the loan's non-recourse, unlike a margin loan or drawing a line of credit. The loan's non-recourse, meaning if the assets fall below the loan, you can walk away from the loan. The loan's always optional, you don't have to pay it back. Why is this quite popular in self-managed super funds? When you gear especially shares, which pay franking credits in a self-managed super fund, you will, depending on your shares and your level of gearing, you will basically create a lot of franking credits, and in a self-managed super fund you actually get that as a cash refund, or you can use that as a contributions tax benefit to some of the contributions that you're paying into super. So that tends to be quite a popular strategy as well.